Good afternoon, everybody. Welcome to your TraderMerlin show for your Tuesday edition. I believe we're looking at what's the 14th of March today. Another exciting day in these markets. Of course, we had the CPI numbers come out today, which everyone's screaming with joy about. That inflation is starting to subside a little bit more. The reality is exactly in line with expectations. There should have been no surprise there, but markets reacted pretty excitedly about that information. But we'll talk about that. We'll also talk about Silicon Valley Bank. We'll also talk about the bond markets, inverted yield curves, all that good stuff, with none other than my guest joining us today, talking about what I call the bond market blueprint. We've got Mr. Bill Addiss joining us from the East Coast today. Bill, how you doing, my friend?
Pleasure to be with you, Merlin. Thank you. Great to talk to you.
Always great having you on. It's like my once a month. I really look forward to getting you on the program. What's new in your world, my friend?
I'm just trying to keep track of this market, the volatility and what's going on, and the bank situation. Where I work with the Fed, and they're obviously having some issues with this. So actually, the banking situation is keeping me a little bit busy these days. So it's nice to know what's going on.
I can imagine that. Okay,
let
me get your 2 cents on this one. Obviously, I'm an outsider when it comes to central banks. I've been in the Mint in San Francisco, but never the Federal Reserve. The actions that happen from the Fed and just regulators, period, it was kind of across the board. We have this sense of security in America knowing that cash deposits up to $250,000 are insured. So if there's a run on the bank, don't worry about it. Don't freak out. You'll get your money at some point. That's the belief. And then securities with SIPC is $500,000. The action that they did with Silicon Valley Bank and Signature kind of made me raise an eyebrow or two. I only have two of them. But, when you say and tell everybody $250,000 is the limit, everything above that is uninsured, and then Silicon Valley Bank goes down where I believe 90% of their depositors had over $250,000, then you're like, oh, we'll make an exception to the rule and we'll insure everything. My faith in the regulator starts to go out the window a little bit, where you're not really doing what you say you're going to do, but because this is such a systemic risk, okay, we have to bend the rules. What's your take on it?
Welcome to the world of the Fed, and welcome to the world of the Treasury. I find it fascinating, honestly, that we're having this conversation on the 28th anniversary to the day of the Fed offering to bail out Bear Stearns.
Yeah.
It was 28 years ago today. And Bear Stearns wasn't a bank. The Fed had no regulatory authority to bail out Bear Stearns. And in fact, they had to revoke that promise. That's why the Fed didn't bail out Lehman. So here we are 28 years ago today. The Fed usurped the authority, if you will, and said, we'll bail out Bear. So the Fed has a habit of doing this. I have a real problem that this is a problem of stupid bankers. That's what happened here. I mean, what happened, and it was done with the Fed's complicit acknowledgement. The Fed has huge accountability here. Now, I don't go as far as Senator Warren did today and said Powell has such conflicted interest here, he should recuse himself for any investigation into Silicon Valley Bank. I mean, I'm not seeing a conspiracy there. But, this was a problem of stupid bankers. I mean, I'm sure everyone in your audience has known for the last year that short-term interest rates were rising, or interest rates in general were rising. The Fed told us they were going to raise them. And here's Silicon Valley Bank ignoring that and not marketing their bonds, taking huge losses because of the interest rate movement. This all comes down to interest rate play. This has nothing to do with cryptocurrency, as I'm sure you've explained to your folks. Just happens to be Silicon Valley Bank. But the reality is they were not marketing their bonds, and they had huge losses. And their losses exceeded their cash flows. So ultimately, when investors came in, the money wasn't there. So this is a case of stupid bankers. And what really bothers me today, I'm going to be on a soapbox today.
We love it.
Is when you hear the talking heads on TV today. I mean, have you heard the ranges of what the expectation is, what the Fed might do now because of Silicon Valley? That we can now, some people talking 75, 50 basis points hike is on the market. 25 has become the most likely, but we've got no more a bank out there saying there's going to be a rate cut next week. I mean, talk about a divergence of opinions. But my question is, the Fed's mandate hasn't changed. Monetary policy here in the U.S. hasn't changed. Inflation didn't go away just because we had some stupid bankers. So I don't understand why people think that the Fed's mandate is now going to suddenly change because we had two banks that were poorly managed. So I don't see a change in Fed policy here. Now, some people will say, yeah, but the Fed caused this problem by raising rates. That's what made the bond prices go down in value. Yeah, you're right. And we pay bankers to manage that risk. It's called asset and liability matching. It's banking 101. Where were these people when this was going on? I
Yeah,
mean, anybody could be a banker in the last 2 years, right? You had 0% money, right? For the last 3 years, bankers have had access to 0% money. If you couldn't make money as a banker in the last 3 years, you shouldn't be in the banking business. But
agreed.
now that the Fed is raising rates, there's implications to that. There's risks that have to be managed. They totally took their eye off the ball.
There were people that were messaging me saying, these people need to go to prison. And I was like, well, no, they don't. They didn't do anything criminal. Like, I think what you nailed it. They did something stupid. And I got to ask you, having worked with the Fed, and of course, I'm sure worked with many financial institutions as well, I can't believe that the executives at that bank didn't realize, hey, we're loading up on treasuries and the yields are soaring, right? And make sure I get this right for Ed up there. The yields were soaring. The bond market was plummeting, right? Now, of course, the past couple of days, bond market has been soaring and yields have been plummeting. But, when those bond prices were tanking like that, they've got to look at it and go, hey, wait, if there's ever a need for us to sell these bonds, we're going to take a pretty big hit here. And no hedging, no protection. It just seems crazy that a bank wouldn't cover themselves.
Absolutely. And I'm going to add another element to this, because again, as you know, I live and breathe the yield curve. And this, once again, is all tied to the yield curve. So we've got one problem is the Fed was raising rates, the value of those bonds were going down, and they weren't having to market. And I stress, they didn't do anything illegal. I think this is a reflection of banking regulations that needs to change. Mm-hmm. Why do they not have to market their portfolio like virtually every other account out there? Separate discussion, but we need more regulation here. But the other problem is over the last year, the yield curve has inverted, right? The traditional bank model is they borrow short term and lend long term. So when we have a normal yield curve, that's how they make money. Borrow short term low, lend it long term high. When the yield curve inverts, that's their worst scenario because they still have to fund short term. So they're borrowing at the highest part of the curve, lending it out longer maturity by nature is lower. So they kind of had this kind of perfect storm of things that happened, but that happened to the entire banking industry. That wasn't something that just was experienced by, Silicon Bank. So
hold on, let me push back on that just a little. Because of what was taken out of Dodd-Frank, so back in 2018, we know the Trump administration said, hey, there's certain things, you just have too much oversight, right? So let's remove some of the oversight for banks that have, I believe it was less than $250 billion worth of assets, which is where Silicon Bank falls squarely into. At that point, there was some oversight and some supervisory stuff that was removed, and that may have kind of forced Silicon Valley Bank to make better loans, right? Make due diligence on their lending, maybe have more protection in place, have more assets and reserves, and not put themselves in that situation. So, you kind of have the perfect storm. You have this incredible rising rate environment, plus hands off from the government. And I see here from Talking Monkey says it's utterly bananas to insure deposits of any size. Doesn't this give banks the right to go full-time risk off? And when you remove that oversight for those banks, it seems like that's the case.
Absolutely. We are rewarding bad behavior here. Ugh. Absolutely. I 100% agree with that observation. I also have to point out one other thing where I have to point some accountability at the Fed, because they have to take some hit here. It was absurd to many people. And we had this conversation over 3 years ago now. Remember when the pandemic hit and the Fed reduced the reserve requirements that banks had to keep on deposit to zero? Mm-hmm. Right? When we have an economy that was as bad as we had to go back to 1918 to try and find something like it, that there was more risk in our banking system than we'd had in decades. What did our Fed say to their owners, the banks? Hey, guess what? You don't have to put as much money on deposit with us. That's exactly the opposite of what prudent risk management would have said to do and what they would have always done in the past. During those periods of time, we should increase the reserve requirements to establish some stability. So the problem is now banks haven't had to keep reserves on deposit at the Fed. They can be much more fully leveraged. They don't have the depths of reserves that would have gotten us through this storm. So I do have to put a commercial in for her. The editor of the author for Forbes magazine, credit section, is just published an article today on Forbes addressing just this, that the Fed did the wrong thing. And we've been saying this for 4 or 5 years. So the banking system is a bit more precarious than we would like it to be. When people talk about systemic risk and will there be other spillover, unfortunately, I think the reason we have that fear is because the Fed did exactly the wrong thing when the pandemic hit. And now we've got a much more fragile banking system. They should have increased reserves. I hope I didn't get too dirty. I hope that makes sense.
No. It's funny. Yesterday we did I've had so many questions on this. I did a session yesterday on fractional reserve banking and explain that kind of step for step and how it works. Because I think a lot of people don't understand that your money is not in your bank. You deposit, it's not there. It's out somewhere else, whether it's in treasuries or investment products or lent out to somebody else. That bank is taking your money, paying you 0.23%, which is the national average, and lending it out to somebody else. That's how they make money. So,
exactly.
Two things. I got to look at one and go, okay, yes, the Fed is I would say responsible, but also maybe more so responsible than I thought, because at a certain point, if these are all member banks and the Federal Reserve is, big daddy it's monitoring them all and making sure everything's okay, you're all following the rules, how is there not a memo that doesn't go out to these banks and say, hey, listen, we know you guys are buying treasuries, and we appreciate that because you're helping out our government. But if you get a run on your bank and you're forced to sell these, you're going to get absolutely clobbered. So you might want to hedge yourself a little bit here. There's no way, if I had a trading room and I had, let's say I'm the trade floor manager and I've got 50 traders and there's some big news announcement coming out that could absolutely screw over all my traders, there's no way I'm not going to sit them down and say, hey guys, listen, at 3:30 today, this announcement to come out, back off your positions. This could slaughter you. It just seems irresponsible. The Fed, I can't believe there was nothing put out there that said, be careful.
I don't disagree. I'm not so sure about alerting them. I mean, honestly, this is so basic. I really say this is banking 101. That for the Fed to send out an announcement saying, gee, interest rates could go up, look out for the price of your bonds, would basically be like saying to a portfolio manager who's an equity portfolio manager, hey, remember, if we go into a recession, equity prices could go down. I mean, it's so fundamental, you'd think you wouldn't even have to tell these institutions this.
Yeah.
The real question I would like to know is, how much did the Fed know how much trouble they were in?
Right.
I mean, the Fed has a supervisory role here. If these banks, I mean, I'm hearing and learning, this portfolio was 100% dedicated as a long-term portfolio, meaning they were committed to not selling it. So they had no liquid reserves, none. Mm-hmm. That's irresponsible. Totally. As a prudent banker, fiduciarily, that's irresponsible. So where is the supervisor, i.e. the Fed, to oversee that? Again, I'm not saying I have to keep stipulating. They didn't do anything illegal, but they sure did something stupid.
Yeah.
That's not illegal, unfortunately.
I agree. It's funny. I actually, I write an article for barchart.com, and I was going to release it on Wednesday, outlining. I made 2 trades on Friday. I made another trade yesterday on Charles Schwab, and the article is titled "The 3 Banks That I'm Buying Right Now." And I personally think that a lot of this hysteria that is just running rampant in the market right now is a little bit overblown, especially when the Fed comes in and says, hey, or not the Fed, the regulators come in and say, hey, we're going to honor all deposits. So then you got to go, well, I don't see much systemic risk anymore. So I guess the question I have for you is, to what extent do you think other banks are going to find themselves in the same situation where other banks, fully long a treasury portfolio? I mean,
that is the $64,000 question now. But now I would actually ask you the argument, given the precedent that was set by the government, doesn't matter.
Yeah, right.
I mean, understand the government just took FDIC insurance and threw it out the window. Well, why is a bank going to pay fee? Because you got to pay for that insurance. Why is a bank going to pay fees for an FDIC insurance if the government has said they're going to step in? There's a real dangerous precedent here.
Yeah.
Real dangerous. I don't like rewarding bad behavior, and that's exactly what this does.
Right. I know that's a comment I've seen a lot, is like you're now just basically telling everybody, okay, you screwed up, but no problem. It's okay. And by the way, you guys paid your bonuses just a couple days before we shut you down. That's kind of nice too, but you can keep that. Like, I would claw that money back right away.
I'm with you. No, there's plenty of accountability here. But the reality is, we are seeing a bond market unlike anything I've seen. I mean, I was adding up the years. I'm 45 years in the bond market, and I've never seen volatility. I mentioned to you about the Bear Stearns situation. Mm-hmm. 28 years ago today, the government stepped in to bail out a large broker-dealer. They weren't even a bank. And we didn't see anywhere near the interest rate volatility we've seen in just the last day. It's just incredible.
Well, let's talk about that. You have some slides. You had some slides all prepped here. Maybe we can dive into those slides and show some of those graphics for the viewers out here. Walk us through. Yeah, I've got them in order, so let's go through so we can cover the whole
Okay.
graphic package here.
Okay, yeah, because it's kind of a progression here. And I really do believe we can tie Silicon Valley Bank into this discussion as well. So what you're looking at here is the Treasury yield curve as of this morning. And we have seen, I'll show you in just a moment, we have seen some major changes in yield. Right here, the 2-year yield on this chart is just over 4%.
Mm-hmm.
And in fact, the 2-year, wait a minute, yield curve today, 2-year. No, this was last week. I'm sorry, this was before. All right, this was the before picture. This chart was taken last Friday.
Oh, I haven't. Do I have them backwards?
Yield, no, I think I sent them to you. My mistake. I didn't send you today's. I sent you Friday's. So let's look at this chart. We can still use it. My mistake. I gave you the wrong one. But if you look at this yield on the 2-year Treasury, now this is our yield curve. U.S. government issues Treasuries from 1 month to 30 years. This is what the yield was on those Treasuries as of Friday before this all hit the fan about Silicon Valley Bank. And the 2-year yield at the time was at about 4.85%. Then over the weekend, Silicon Valley happened. And what happened? We saw a major repricing in the bond market. That 2-year yield today was down at 4.05% yesterday. We have seen a 100 basis point drop in that 2-year yield in just 3 business days. 100 basis points.
Oh.
I mean, it used to be interest rates change 100 basis points in a year. I mean, we had 55 basis points in just one day. So we had a major repricing in the bond market. Now, why? Right? Issue number one is, pardon me, there was a flight to quality. We see that all the time. You saw it in gold, you saw it in other assets. Anytime the world gets nervous about banks or the US gets nervous about banks, there's a run on treasuries. So we saw huge price increases, yield dropping. The other issue, though, that's really come into play is that there is now the growing, I'm almost going to say, expectation that the Fed is now going to not be as aggressive about raising rates as a result of this banking situation.
Mm-hmm.
The marketplace is pricing in less rate hikes today than they were last Friday.
Right.
So, this is a common consensus. I'm going to go out there. I don't believe it. I think that's equity optimists out there because inflation, as we saw this morning, has not gone away. I mean, this was the highest number in 5 months. You can paint it as a good news, bad news scenario. Inflation hasn't gone away, and inflation is not going to go away just because we have a couple of stupid bankers in California. So I'm still looking at the 50 basis points. And, when you hear firms like Nomura saying, they're going to cut now,
yeah,
that's just stupid. They're just looking to get in the conversation. Whoever heard or cares what Nomura thinks.
Yeah, that's a total Kim Kardashian move right there. You say something that's just kind of a shock factor, so you get some press. Yeah,
absolutely. But I think there's a lot of that going on. I've been glued to the screens over the last 2 days. There's a lot of that going on amongst the talking heads out there.
Let me show these guys the current Fed funds futures right here. You have the expectations. I am in the 25 basis point camp. I think that since the last meeting they cut 25 basis points, I think they'll stay at 25 until they feel that it's doing its job. If things get out of hand, they might go to 50. If things really drop, then they'll go to a neutral stance. But they'll keep 25, at least in my opinion. You can tell right now that the forecast is that 79% chance of a 25 basis point increase at the next meeting. Of course, that's going to be next week, so that should be an exciting one. And that's actually a little bit of an increase over what we saw yesterday. Yesterday was 65%. A lot of people all of a sudden freaking out saying, hey, they're going to halt. Look, inflation is still fairly high. I mean, they said 2%. Here's a chart of the inflation, the CPI number year over year. And you can see it's been drifting down from that 8.9% peak, 9.1% peak. It's drifting, but it ain't nowhere near 2%. So
absolutely. The Fed's mandate has not disappeared because we had 2 banks that had a problem.
Yep.
I really think it's just a lot of talking heads screaming. I really do. And I'm even going to go so far, and given all the conversations we've had over the years, maybe I'm getting cynical. But when we come down to it, in the general scheme of things, does it really make a difference next week whether the Fed raises 25 or 50?
No.
does it really matter? I mean, if they did nothing, that would be a real policy difference. So, that would be substantial. But, in the long run, does it really matter? I mean, I'm just amazed at the amount of oxygen that's spent on the talking heads debating this next week. Is it going to be 25? Is it going to be 50? In the long run, they've committed to further rate hikes based on the blue dots. We know they're going to hike more after that. And until they change that posture, what does it really matter whether it's 25 or 50 next week?
Right. And here's the dot plot for anybody who is interested in the dot plot. It's always an interesting one to check out. Let me zoom in just a little bit here. You can see for 2023, we are currently sitting at this 5.25 level. That's the expectation. Let's go right to the expectations are we're going to end at 5.25. But you have some people saying, 5.75. It is somewhat spread out. You got one lone straggler here saying it's going to go to 4.25 by the end of the year, but I pretty don't think that that's going to happen. But over the next few years, you can see it dropping back down. And of course, forecasting out Fed funds futures or interest rates into 2025 and 2026 to me is a fool's errand. You don't know what's going to happen at all. So don't even pay attention to any of this stuff here. They all want to give you that sense of hope and, it's going to be great down the road because we're doing our job. So, I wouldn't worry about that. It's right now, at least for me anyway, the thing that matters is looking at the current, saying, when's this next meeting? It's going to be next Wednesday, the 22nd. And when that happens, back away from your computer a little bit because you're going to get some very wild action. Most likely, you'll get yourself what we like to call the popcorn trade of the day. There's my wonderful graphic of the popcorn trade of the day, which, it's going to look just like that. Tons of volatility, and then things will start to take a direction based off what the market is digesting from those announcements.
Exactly. And as you know, we'll microanalyze every adjective and every adverb.
Yep. I love when what? I'm pissed off at you because you do this to me. You've made me now. I watch every FOMC press conference. I watch the announcement and the press conference, and I'm literally writing down the words that have changed. I'm like, damn you, Bill. This is all your fault.
That's done. No problem.
Cool.
So, I'll jump back in. We were talking about the yield curve, and I was saying that if there's any good news to this last activity we've seen, is that the yield curve is less inverted today than it was last week by a substantial amount.
Mm-hmm.
All of the volatility we've seen over the last 3 days has been in the short end. And net, short rates have come down much more significantly than long rates. So they were the more aggressive going up. They're now the more aggressive coming down. We'll see if they stay down here. But the yield curve, as a result, is much less inverted. So that's a little bit more optimistic as to the economy.
It's funny you mentioned that you said all the volatility was in the short end. I mean, watching the 10-year drop 50 basis points in 2 days, I would argue that's pretty immense.
No. I'm not going to disagree, but when you compare that with 100 basis points on the 2-year,
right.
No, you can go across the curve, and don't get me wrong, we're seeing huge volatility. But on a relative basis, it's the short end that is, contrary to what we usually see,
right,
showing most of the yield volatility. Now, again, as we know, that doesn't mean there's price volatility, because those bonds are not as volatile. They don't have as much duration. So from a price point of view, the long rates are showing a lot of volatility, but that's because of that dreaded concept we talked about of duration.
Right. On this chart here, guys, you can see this is the 10-year versus the 2-year, which is the industry's definition of yield curve. Bill makes a good argument that the 10 and the 1 is the much better one. If you look at the move we've had since Wednesday of last week, we were inverted over 1% on the 10 and the 2. Now it's only 56 basis points. So there still is an inversion. It's just not as aggressive as it was before, which is a good sign for anybody who's hanging their hat on this yield curve being so destructive to our economy. If that does start to balance out and get back above zero, then okay, we can maybe breathe a little sigh of relief, at least from the inverted yield curve perspective.
Absolutely. And there's been growing consensus that the depth of the yield curve, the inversion, predicts how deep the recession will be. So this is being perceived as good market reaction.
Awesome. All right, I'm gonna try a couple
the next slide we had was the only thing I wanted to show you on this slide for the group's benefit, because we all lived through this. It's just what a dramatic shift we've had in interest rates over the last year.
Right.
You go back literally a year ago on the right-hand side, we had as normal a yield curve as you could possibly imagine, right? Short-term rates low, long-term rates high. And literally, look what a difference a year makes. Right now, the short rates have driven so dramatically thanks to the Fed. Now, I apologize, the scales are different on this, but bottom line, both long-term and short-term rates have gone higher. It's just that short rates have gone up so much more. This is the yield curve right now that's hurting the banks. Because again, banks always still, and they do today, banks borrow short term and they lend out long term. So a year ago, that spread was positive. They were making money. Today, that spread is negative. That's a problem for banks.
You mentioned having done this for so long that you've never seen this kind of volatility. Is that in reference to this slide here, the next one, which talked about the 1 day? I mean, a 50 basis point in the 1 year, 8 basis points for the 30 year. I mean, this is pretty wild.
It is amazing. And this is just 1 day. So yeah, this next slide, thank you. So this is just comparing Friday's activity to Monday, where the yields were on the bonds. So the 1 year went from a 490 yield on Friday, then along comes Signature of Silicon Bank and Signature. And yesterday, the 1 year was trading by the end of the day at a 435. It dropped 55 basis points in yield, meaning it went up in price as a result. I mean, we're talking about major price appreciation in the bond market yesterday. The 2 year, which, by the way, I'm coming around to being a convert to your 2 year, by the way.
All right.
I'm seeing huge significance. I don't know if we mentioned it, and I meant to. Mohammed El-Arian is an economist I greatly respect. He's now at the University of Cambridge as their president. He used to be PIMCO. He's one of your Newport, PIMCO guys.
Mm-hmm.
He did a great article in the FT last month that correlated the performance of the equity market to the 2 year treasury. That the 2 years really become a nice sweet spot because it reflects what the Fed is doing, but you also have some kind of future projection to it. You've got a 2 year time horizon. And they're showing some interesting correlation between the 2 year yield and the treasury, and the equity market. But on Friday, the 2 year was yielding 460. By yesterday afternoon, the 2 year was down to a 405,
Wow.
55 basis points. And if we go back even to Wednesday of last week, that same 2 year, I'm getting excited. I'm losing my breath. I have to get a light. That same 2 year was yielding over 5%. It's dropped 100 basis points in 3 business days. You've never seen. I mean, I'm a bond trader. I was 30 years a bond trader at Lehman. I would have killed for this type of volatility.
Mm-hmm.
I go back to the days where even though interest rates were 14 and 15%, you still only got 5 or 10 basis points at most in a day. Here we're looking at 100 basis point change in 3 days. I hope your trading audience is aware of this.
Yeah. Yeah, and in your final one here, you talk about this are just some other ones because obviously people aren't maybe buying outright bonds, but you can look at the different ETFs like SHY and IEF that had huge moves as well.
Yeah, and that's what I was trying to show because what I was trying to do here for your audience was I'm a bond guy. I tend to talk yield on everything. That's what we do. But you guys talk price. What happened to the price of these? So when we look at these dramatic changes in short-term interest rates, I like ETFs. And the SHY is an ETF sponsored by BlackRock that trades a basket of short-term treasuries, average maturity from 1 to 3 years. So when you had these huge changes in interest rates on Friday and Monday, this is the ETF that I would use rather than trade the bond market itself. ETFs, as your audience knows, a lot more liquid. So on that, when the short-term interest rates went down by 55 basis points yesterday, this ETF was up by 1% in price.
Mm-hmm.
1% in 1 day in price volatility on what many people think are dull and boring bonds. This is, I keep saying it all the time, this is on not my grandmother's bond market.
Yeah.
You're getting 1% price change in 1 day or 2% over the 3 days.
I have the chart up here.
Yeah.
I have the chart up here on this side, and it's up 2% in 3 trading sessions. And now it's dropped back down a little bit, but from peak to trough or trough to peak, 2%. Pretty incredible.
This is unprecedented volatility. Now, the longer portfolio, if you want to trade that 10-year, and I apologize, this is 7 to 10 year. There's an IEF, which again is a BlackRock product. I'm not trying to be a commercial for BlackRock, but these are the 2 largest within the category, so it's just safe to use them.
We'll forgive you. We'll forgive you.
But anyway, the IEF is a portfolio of 10-year maturity treasuries. And yesterday, that was up by 1.2%. I mean, again, 1 day volatility in a product that many people think is, a dull, boring, clip the coupons and forget about it. This is a hugely volatile market, huge trading opportunity.
On the grand scale, I'm leaning way far back from my viewers at home because now, since Bill's mic is coming through my microphone, it sounds muffled. So I turned my microphone up. I'm leaning way back so it doesn't get too loud. Bill, when you look at what's happened over the past, let's just say, well, since Friday, right? Go back the past few days. Obviously, a lot of uncertainty, a lot of chaos, a lot of fear. But ultimately, government steps in and bails things out, so the damage most likely won't be as severe. I still think there are some financial issues going forward. I do think that you'll see regulators pound the soapbox and say, we need to, reinstate those components of Dodd-Frank that were taken out, get some oversight in these smaller banks. But from the Fed's perspective, let me ask you this. They said the taxpayers will not pay for this, that there's a fund that was paid into by banks that is now $100 billion, so no money will come from the taxpayers at all. Do you believe this or not?
Yes. No, I believe that. I don't believe they make things like that up. I really don't. I'm a purist at heart, I guess. So, yes. Now, what I don't know, and I haven't had time to look, is where is that fund? In other words, is this an FDIC fund? I also heard this afternoon, I apologize, I was in training myself doing classes today, but apparently one of the government regulators and agencies announced a $2 billion bond offering today, that apparently the proceeds are going to be used. I would remind you that the government enjoys a great degree of flexibility. Remember, many of you live out in California. Remember when California used to have a savings and loan industry?
Yep.
You know what I mean? Like California Fed and Columbia Savings and all of that. Well, when the savings and loan industry got wiped out, we literally created, some of you might remember, we created a whole new government agency just to merge together and liquidate savings and loans here in the U.S. I mean, so, God forbid the situation gets more dramatic. I think the government has shown not only huge flexibility, but I think kind of overextending their reach. I really would like to know, was this even a bailout? I realize that question is still on the table. Was this really a bailout? Or is this basically going to be a facilitated sale? They sold off the UK operations for £1 to HSBC this morning, but we really don't know. Is this actually a bailout? Or is this going to be a facilitated sale?
Mm-hmm.
But the Fed and the government, when I say the government, the Treasury Department, and the Fed really have an amazing degree of flexibility. It frightens some people, and I can understand why. But Resolution Trust Company, RTC, was a government agency that was created just for the purpose of liquidating savings and loans. Most of them out there around you guys in California.
Mm-hmm. Good comment here from Talking Monkeys is, but banks will pass costs of FDI insurance on to the customers, which will probably get more expensive. I think that's a logical thought, that if this is going to be such a huge financial hit to that fund of $100 billion, that they most likely will raise the cost of FDIC insurance, which will get passed on to us.
Yeah. But I would make you the argument, and not to be contrarian, isn't that the way it should be? I mean, why should the general taxpaying public pay for somebody's safety for their money in a bank? If you're going to keep your money in a bank, you should have to pay for the insurance. I personally don't have a problem with that. But is the value of the insurance mean anything if the executive department branch is going to step in and say, we'll guarantee everybody?
Yeah, right.
Why are we paying that insurance fee?
Yeah, kind of a strange one.
Yeah.
All right. Well, let me give you a chance to plug your wares. I know you have some classes coming up for OTA. I know you're doing some other things as well. I've got your slide up here, so walk me through the goodies.
Yeah, I'm pleased. I'm going to be doing more work with you guys, and I've enjoyed it. So we just scheduled today my next XL2. We're doing a monthly series. And for February 4th, we're going to put on the schedule, it's going to be Bonds 101. I am a firm advocate, as you know, that many people could and should, if they just knew more, could be buyers of individual bonds for income and safety and all the reasons we used to buy bonds. But I think bonds scare people. They intimidate people. They don't understand the terminology or how to do it. So on the 4th of, I said February, the 4th of April, we're going to do Bonds 101. Let's demystify the jargon, the terminology, and even a little bit of the mechanics if you want to be a bond buyer. So this is not for the trading side of it. It's just to demystify. But honestly, as we've shown in this session today, bonds are permeating every asset category. So even those of you who aren't interested in bonds per se might be interested, because the jargon and lingo that we're going to be talking about is the same jargon and lingo the talking heads are talking about, and talking about just the things we've been talking about here today. So it's not just meant for the bond buyer. Then I've also finally delivered a series of classes to join the focus series.
Oh, good.
My proposal, we've been talking to Larry, we're looking like it might probably be two different classes. One for the trading market, because bonds are such a great, ETFs are such a great trading vehicle for bonds, and being the traditional bond buyers, things like ladders and the more passive income. So we're going to try and appeal to both, and we hope to get those out on the schedule as quickly as possible. Finally got off my desk onto Larry's. So good things ahead.
Good. I'm glad to hear that. About time. I've been waiting for those series. My focus session starts tomorrow, by the way. So we're both gonna be focus buddies.
Excellent. We'll be focus buddies. I look forward to it. Now, forgive me. I've been out of the loop, as you know. What is your topic and what are you doing? Put in a commercial for you, please.
Just digital assets and crypto. That's it.
Good. Just. I love that. So that's it. That's it.
Which might be a question. I have a question for you on that. Silicon Valley Bank obviously is, a VC startup helping with a lot of VCs and tech startups. Signature also is probably the biggest onboarding on-ramp for people into crypto, and many have made the argument that Signature wasn't in the same financial situation, but there's conspiracy theorists out there who are saying that they were seized because they're one of the last onboarding into crypto. And as we've seen by Gary Gensler, there is an attack on digital assets and cryptocurrencies, even coming from Capitol Hill. Elizabeth Warren and several others are just going after it. Do you subscribe into that this is somewhat utilizing this situation as somewhat of a coordinated attack to say, hey, digital assets are a systemic risk. Let's make sure we keep it, under our supervision and keep crypto out?
That's a good question, but I'll be honest with you, I'm not sure I share that, but I do agree. First off, that there will be huge and negative implications to the crypto market in terms of product development, funding, and so on. I don't mean to say that this won't affect crypto. I was just saying earlier in the day that it wasn't caused by the price of crypto going down. But no, I think there's going to be huge ramifications. And I wouldn't be surprised if every politician who has their own orientation, like Elizabeth Warren, is going to use this to try and make that argument. But I still come down to, I don't think the Fed was conspiratory in going after Silicon Valley because their business model is in Silicon Valley. I mean, this institution's been around for 40 years. This is not some startup. There's long-standing relationships. But do I think this will give politicians an ammunition that they want to take for the argument either way, for that matter? Absolutely. They're going to make political hay out of this. But I don't think that was the motivation. I really don't.
Okay.
It really just comes down to stupid bankers. It's just that simple. That's my motto.
You said down to stupid bankers. Let's say rich, stupid bankers.
Rich, stupid bankers. Absolutely. Rich, stupid bankers. That's what it comes down to. I'm with you on the clawbacks. No, this was reprehensible. I really have to refer you to Myra's article in Forbes magazine.
Yeah, send it to me.
Within the credit risk community, they're just shaking their head at this one. How can you be so stupid?
Yeah. Last one, and then we'll wind things down here. Chase says, this is a tweet, says the decline in the 2-year was larger than any one day seen during the 2007 and 2009 financial crisis, following 9/11 and the 1987 stock exchange. What is this telling us?
Honestly, it's telling us the market uncertainty. I mean, you and I have been saying this all during the pandemic. We are literally in unprecedented territory here. The fact that we've been dealing with this stagflation issue, unprecedented. How many times do you hear on TV, we haven't had this since 1987? I've been tired of hearing that 15, 20 times. Let's go back to 1987. But even those analogies are not accurate because we're swimming in so much more cash today. I also have to say that I do think we're seeing exaggerated volatility for kind of the reasons we were talking about earlier. A lot of people screaming, the sky is falling, the sky is falling. There's a heightened sense of, what do I want to say, angst. Everybody's yelling. And the marketplace can't figure out, do we have an inflation problem or are we going into a recession? That's the bottom line question the bond market is asking. And when we get a number like we got this morning that says, we're not done with inflation yet, that sends a different message than we get a number that we might get tomorrow that says, no, we're going into a recession. And it's that schizophrenia is what's causing this volatility. And in my 45 years, I've never seen this much, let's call it schizophrenia, for lack of a better word.
I like it. I like the schizophrenia. You're right. It is nuts. And tomorrow's going to be even worse. I'll go through the economic calendar here in just a second for everybody. But yeah. Well, hey, thank you so much for coming on. Sorry for a little audio problem. I think that was on my end somehow. I'm going to have to spend the rest of the day trying to fix that thing.
Best of luck to you on the tech side. Not my forte either. Always a pleasure talking to you, Merlin. Even with the lag, it's always a pleasure. Anytime.
Awesome. Thank you, Bill, so much. I appreciate it, and I'll talk to you soon.
Be well. Be well to everybody. Safe trading.
All right, take care.
Be well.
All right, guys, that was Bill Addiss. Hopefully, I can fix the audio issues. I apologize for what happened there. Bill, as he mentioned, will be doing an XLT in April. He's also doing a focus class, which is also going to be, I'm pretty excited to hear that one. The focus model is a little bit different. That's something that I guess OTA is moving a lot of their classes to that kind of focus session, which I'll be doing a crypto focus series starting tomorrow morning as well. You mentioned he's got those books. We talked about those books that are available. If you go to aftraining.co/shop, he's got that 3-pack of books, which is fixed income investments, equities, and derivatives for $25 with free shipping. So hard to beat that from a price perspective, and you get free shipping. And he's got a bunch of YouTube videos on his aftraining.co site as well. I've actually had the privilege of recording some videos in the past with him, and he's just always just such a great guy to work with. Love having Bill Addiss on the program. All right. Let me go into tomorrow's activity. So we talked about the consumer price index numbers, and of course that is a critical one that moved the markets today, although it actually came in line with expectations. I will bring that one up here so you guys can see the data and see what the end result was, which I actually brought this up already. Here is your consumer price index. You can see, let me refresh that bad boy. I don't know why it's not, there you go. So the expectation was we're going to go from 6.4% to 6%. Okay, great. We were in line with expectations, right? Came out right where it's supposed to, and the markets did rather well today. Let me bring up the end of day results here. Scroll up and go from the bottom to the top. Yes, we will talk about crypto here in just a second. Crude oil was your big loser, down 4.6%. The challenge here now is that yellow box. I kind of hope we stay in it. I love the fact it just kind of bounces back and forth between this top range and bottom of the yellow box. But it's challenging that lower end right now, which will be right around $70.50. We'll see if that one holds tomorrow. Gold gave back a little bit of its great gains over the past 4 trading sessions, closing at 1910. Your Dow, 1.08% gain. Most of these indexes off their highs just a little bit. NASDAQ actually closing really close to its dead high. We're almost at the podium. I got 4th place at the S&P 500, up 1.68%, closing at 39.54. It's still in the midst of a pretty significant downtrend, at least for the month from February on. Russell 2000 is your 3rd place, which, no surprise, we talked about that on yesterday's show. Came down to this area of demand, would most likely see a bounce there. We got a nice bounce out of it today to 1.95%. It was up much more than that during the session, but giving back some of those gains. Best performer from an index perspective was the NASDAQ, which also had a over 1.9%. It was 2.34% gain. And what noteworthy for me was, did you watch the last hour of the day? Just a really nice rip up that last hour of the market. And we're kind of hesitating right now in the after hours, but a great move in that last hour, showing a lot of optimism, which most likely, typically when you see those types of moves in the last hour, it translates into a gap up tomorrow morning. But, there's so much time between now and the next market open. And the best performer, Bitcoin. Now, Bitcoin's given back quite a bit of its gains that it had. It was up over 26,600 early this morning, which obviously for me was a great thing to see. And there's a lot of speculation on why this is. There's a speculation that the Fed may stop their rate raising environment and therefore more money can pour back into Bitcoin. I think for a lot of people, it's just saying, you know what? Bitcoin's a better banking system. You don't do a bailout of Bitcoin because it doesn't need a bailout. You don't need to worry about your deposits other than, did you lose your private keys? You are in control of your deposits. So I think a large part of the reason you've seen Bitcoin have a 35% move over the past week is partially that. Actually, not even the past week. We go from those lows we saw back here on Friday to where we are today. You're about 36% from bottom to the very top. It's pulled back some right now, but I think a lot of this is the understanding and realization that Bitcoin in many ways does provide for a better banking system that's not manipulated and as our current system is. Now, there's certainly a lot of problems with cryptocurrencies and digital assets now, but as adoption sets in, the argument, I think, will start to become broader of Maybe this is a better banking system to use something like Bitcoin, but that's a topic for another day. Most of the crypto assets were moving great. I can scroll down here through just the list of crypto that I have, and you'll notice a lot of big positive numbers here. Let's go to, Fetch.ai up 15%, Gala up 10%, and that's just today. Over the past week, a lot of these have done very, very well. In my entire watch list, I've only got a few here that are in the negative side of things. And unfortunately, it's not Shiba Inu or Dogecoin. Positioning for PPI tomorrow, retail. Well, let's talk about that. Here is your list of tomorrow's economic announcements for the 15th of March. You can see right at the top, 5:30 in the morning Eastern time. That's 5:30 in the morning Pacific time. That's 1 hour before the equity markets open. We have PPI numbers come out, which are expected to do the same thing as we saw with consumer price index, drop by 0.1% from 0.5 to 0.4. However, tomorrow gives you some other pieces that give us a little better reading of what's going on in the broader economy. You can see there's the Empire State Manufacturing Index, which is expected to decline, which means worsening conditions in the New York area for manufacturing. You also have the retail sales numbers coming out, which are expected to go from a 0.3% gain, a 3% gain to a 0.3% loss. So that's not really good news for anybody who's looking for that catalyst from consumers to help push markets up. Here is your chart of retail sales. You guys can take a peek at that one. We had this one big bar that popped up in the most recent reading. My guess is it'll probably come close to zero and bounce right back down. You notice historically, if we take out what happened after the pandemic and go back into, let's say, 2006 all the way to 2017, well, you see it stays pretty consistently down below this 2.5 mark. It seems to me like the average looks at about 1.5 on retail sales. So 3 might be a little bit rich for us at this moment in time. My guess is you'll probably see it pull back just a little bit. Let's see. I got a few comments. Let me read them. I don't see any question marks, so no, they're not for me. Positioning for PPI and retail sales tomorrow might be, Liz. That might be the case as to why you saw these markets rally. I think it's just optimism leaking in. You have the Fed or the regulators have bailed out the banks. They're not calling it a bailout, but you've now prevented them from failing. And again, if they failed, we talked about this on yesterday's show, if they let Silicon Valley Bank fail outright, massive pain point going forward. Massive. It would have been a very, very bad thing. Did I put that in there? I thought they had it. Oh, yeah, the annual budget. Yeah, sure, you could argue that one. That's actually, you see right there at the top, the GBP annual budget release. Typically, that's not a huge major market mover. It's things like GDP and unemployment numbers really start to drive those markets. You can see down at the bottom of the page, though, tomorrow night you have Australia with their unemployment rate. And again, there are other announcements for the U.S. There's so much happening tomorrow. 1 p.m. tomorrow, Pacific TIC long-term purchases. You also have crude oil inventories, and maybe that's part of the reason we saw such a precipitous decline today in crude oil. That was a pretty sharp slide, almost 5%, and finishing right near those session lows. BTC is a hedge against government manipulation, in my opinion. Yep. There was a talk track a while back saying that Bitcoin's a hedge for inflation. I don't know if that's necessarily true. I think until Bitcoin gets mass adoption, meaning everybody has some fraction of a Bitcoin, then I think the volatility is still going to be way too high, and I don't think it'll necessarily be a hedge against inflation. But once it gets adoption, which I do think will happen over time, then I think you'll start to have price stability for Bitcoin, which is one that I think most people will be happy with. I was like, have some stability here. And as inflation starts to rise, the value of Bitcoin would be increasing based off that. Okay, that's it. I'm going to wrap up. I'm going to see if I can fix whatever happened here on my audio system. I don't know what happened, but I will now put on my IT hat and hopefully fix that one, and then teach my crypto class this evening. And I got a crypto class tomorrow morning, so it's going to be a busy couple days. Hopefully my voice won't be totally trashed tomorrow. I was debating actually canceling tomorrow's show just because I'm going to be teaching for 8 hours and I won't have a chance to prep for the show. So tomorrow might be a wing it from the seat of my pants kind of show. My class finishes at 1:30 Pacific time tomorrow, and the show is obviously at 2, so I'm going to have almost no time to prep or do anything for the show. So maybe if you can give me a talk, something you would like to discuss tomorrow that I don't have to do a lot of research on, that'd be fun. That's always fun for me. If you have questions, let me know. Send them on in at TraderMerlin@gmail.com. You can email me there or post your comments down below the YouTube videos. I will gather those tonight since I have been neglectful for the past couple of days on the YouTube videos. How do we sign up for those crypto classes? You go to tradingacademy.com is where they are. TradingAcademy.com, the Focus series, and then the CIL is the higher end version of that. Merlin, OTA crypto tomorrow, and is it OTA? Yes, the crypto class tomorrow is at OTA. It starts at 7:30, I think 7:30 Pacific time, so it's gonna be an early one. Anyway, thank you guys so much. Hope you enjoyed Bill Addiss on today's program. I will see you guys tomorrow for a hopefully where I'm not going to sound like Barry White on the show. Again, if you have something you want me to discuss, just email me at TraderMerlin@gmail.com, and hopefully I can get to all that without a lot of prep since I'm not going to have much time tomorrow. Take care, everybody. Have a great night.